Hi there, I'm Peter Russell from Supertax. Thanks for watching another one of my video blogs. Today's topic is on the taxation of employee stock options here in Canada. Now, this is the first of two videos on this topic. The second video will consist of a walkthrough of an example of how to calculate the taxable components of a stock option transaction. Now, what exactly is a stock option? It's where an employee has the option to purchase from an employer a specific amount of shares during a vesting period for a predetermined price. Now, two types of corporations generally issue stock options: public corporations and non-public corporations. Non-public corporations are also called CCPCs, Canadian Controlled Private Corporations. They cannot be owned by public corporations or non-residents of Canada. Generally, they're privately owned, usually by individuals. Now, employee stock options have three tax components. The first is called the benefit income inclusion. What this is the difference between the fair market value of the shares when you exercise the options and the exercise price. This figure multiplied by the number of shares you are exercising calculates into a taxable benefit. Now, if the stock options are from a CCPC, this taxable benefit can be deferred until disposition of the shares. If the share options are from a public corporation, you cannot defer this taxable benefit. It is taxed immediately in the year you exercise these shares. Now, the second component is called the option benefit deduction. This benefit deduction is also Section 110, 1D, and 1D1 of the Income Tax Act. It is equal to 50% of the option income inclusion. The option benefit income inclusion. Now, if you're a CCPC, all you have to do to be able to be eligible for this deduction is that you must be a Canadian resident, you must deal with this CCPC corporation at arm's length, and you must at least hold the shares for 2 years. If you don't meet the 2-year criteria, then all you have to do is meet the criteria for public shares. Now, let's assume that the shares were public shares. There's additional criteria as mentioned. The first major criteria is that the exercise price of your options must be greater than or equal to the fair market value of the shares on the date of the options were granted. Secondly, the shares must be common shares. Third, you must be a Canadian resident. 4, you must be dealing at arm's length with the corporation. If you met that criteria, then you'll be eligible for the option benefit deduction if it's a public corporation shares. Now, the third component of this calculation is the capital gains or capital loss calculation. That will be equal to proceeds of disposition on sale of these shares less your adjusted cost base, equals either a capital gain or a capital loss. Half of those figures are taxable or can be carried back to another year. Now, how do we determine the ACB of your shares? Well, what it will be is your exercise price times the number of shares you purchased plus your taxable benefit, whatever your optional benefit income inclusion is. That will equal your ACB. Okay, so that's the technical explanation of how we determine what is taxable and what is not with stock options. Now in my next video, as I mentioned before, I walk through an example of how we calculate this. So look out for my next video on how to calculate stock options. If you have any questions or comments about this video, please feel free to leave a note below or send me an email at peter@supertax.ca. Thank you very much.